Rolling into retirement, most people think taxes are just something they're going to have to deal with. After all, you did spend the majority of your career deferring taxes on your contributions to retirement plans, so now it's time to pay the piper, right? Well, not necessarily, because with the right strategy, it's possible to retire with income, real usable income, and pay $0 in federal income tax. This isn't magic, it's not a loophole, it's just smart asset location and sequence of withdrawals. In this video, I'll break down what I call the taxless retirement blueprint and show you how retirees with moderate to even substantial portfolios can legally avoid paying income tax for years, sometimes decades into their retirement. Before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. To follow the taxless retirement blueprint, the first thing you need to do is understand what type of taxable buckets you have. The first type of bucket is the taxable account. Think brokerage accounts, savings accounts, or CDs. You've already paid tax on these dollars, and the capital that you've invested is now receiving capital gains, dividends, or interest as they grow. There's also the tax-deferred bucket, which is your traditional 401k or IRA. You receive an upfront tax break for contributing here, but you're going to pay taxes on the distributions in retirement. And finally, there's your Roth bucket, or the tax-free bucket. And this is money that you've contributed to a retirement plan post-tax. This money then grows within the plan and then is distributed to you tax-free in retirement. So to pull off the taxless retirement strategy, you might need a mix of all three. And a smart strategy is to pull from them in the correct order. The second step in the taxless retirement blueprint is to use your standard deduction strategically. For 2025, the standard deduction for married couple filing jointly is $31,500. If you're a single filer, it's half of that, or $15,750. And if you're over the age of 65, you get an additional $1,600 added to your standard deduction. So if you're married and both spouses are over the age of 65, that's an extra $3,200 in savings on your taxable income. And for those of you who are able to itemize your deductions, you might be able to claim even more than that. But in addition, on the standard deduction side, there's also a $6,000 per person enhanced senior deduction for individuals who are over the age of 65, and that's going to happen now in 2025 all the way until 2028. That means a married couple can generate up to $46,700 in ordinary income and pay nothing in federal income tax because of these new standard deduction limits. So what type of income would qualify here? Well, withdrawals from your traditional IRA or 401k count as ordinary income. So do Social Security benefits, though depending on your income level, only part of these may be taxable. The trick is to fill up the standard deduction with just enough IRA income, then stop before you trigger an actual tax event. If you're married over 65 and take $46,700 out of a traditional IRA and have no other income, you will pay nothing in federal income tax under the current tax structure. So after accounting for your standard deduction, your withdrawal sequencing at the very beginning, you now want to start layering in your capital gains. So you'll tap into your taxable account to do this, but only the gains portion. And here's where it gets really powerful. In 2025, long-term capital gains are taxed at 0% for married couples with taxable income of $96,700 or less. So after filling up your standard deduction, assuming you're over the age of 65, with those tax-deferred withdrawals, you can still take tens of thousands of dollars in long-term gains from your brokerage account and pay nothing on them. It's not just theory, it's in the tax code. Here's the example. You withdraw $46,700 from your IRA so it fills your standard deduction. You realize $96,700 in gains from your taxable account. You owe $0 in federal income tax in this instance. Why? Because your taxable income has been offset by the standard deduction and then the higher capital gains limit for the 0% bracket of $96,700. If you find yourself wanting to spend more than that, you would want to consider pulling from your Roth IRA next in order to supplement the rest of your withdrawals. Roth withdrawals, both principal and growth, are tax-free in retirement as long as the account's been open for 5 years and you're over the age of 59 and a half. So if you need more to live comfortably, you may want to consider Roth withdrawals at that point to keep in the 0% tax strategy. I do normally advise to leave Roth funds alone until the very end of your plan or until they're the last asset left to deplete. But if you're in a pinch, need money, and another dollar of income will trigger capital gains or ordinary income tax that will have you incur thousands of dollars of taxes you weren't planning for, that's when you would want to turn to the Roth distribution. The taxless retirement blueprint focuses on one aspect of your distribution planning, paying nothing in the way of federal income taxes. but it's not right for everyone. Here's a few things you'd want to keep in mind if you are planning to follow the strategy. First is Social Security taxation. Once your combined income crosses certain thresholds, a portion of your Social Security benefits become taxable. This can sneak up on you if you layer too much IRA income or capital gains income in a given year. That's why you typically want to utilize this strategy before you start taking Social Security. You also want to be mindful of IRMAA surcharges because Medicare premiums will go up if your modified adjusted gross income exceeds certain levels. Even tax-free capital gains and Roth conversions can count here. And you also want to be mindful of state income taxes. This strategy focuses on federal taxes only and does nothing to help you optimize for state taxes. Typically, they go hand in hand, but what may be $0 in tax at the federal level could be thousands of dollars at the state level. So you just want to be mindful of both when you are following the strategy. But make sure you don't wait too long before you start implementing the strategy. Many retirees think they should leave their Roth alone for as long as possible. But if you wait until RMDs kick in at 73 or 75, your required withdrawals from IRAs can explode your taxable income. That's often why we recommend Roth conversions early in retirement years, especially if you've stopped working and have yet to take Social Security. This creates a valley of low-income years where strategic planning can have a massive long-term impact, often to the tune of hundreds of thousands to millions of dollars in tax savings. By converting IRA dollars to Roth while your income is low, you can reduce your future RMD burden and increase your tax-free flexibility later on in life as well. So now let's talk about the zero tax couple. And this is a real-world example loosely based off of some clients that I do work with. So we're going to meet Mark and Linda. They're both 66, they recently retired, and they're living off their savings. They have $500,000 in a traditional IRA, $200,000 in a Roth, and $300,000 in taxable brokerage account with $100,000 worth of unrealized gains. They have no mortgage and their expenses on an annual basis are about $80,000 a year, which comes out to roughly $6,500, $6,700 a month. So here's how we might build a tax-free income plan for them in retirement. Step one would be to withdraw $46,700 from their traditional IRA. This will fill up their standard deduction plus their enhanced benefit that they're able to get between the years 2025 and 2028. Next, we want to realize $96,700 in long-term capital gains from the brokerage account and tax that at 0%. The third step, well, now they have options. They can take that money and take a nice vacation, or they could do the prudent thing and reinvest it back in the taxable account and increase their basis, further reducing capital gains exposure on subsequent years' distributions. So all said, they have total taxable income of $96,700, and they have not paid the IRS a single dime in federal income taxes. But what might even be smarter is starting to convert the traditional IRA in that scenario even more aggressively to Roth dollars. Mark and Linda can fill up the 10% bracket or even the 12% bracket and start converting more of the balance at a lower tax rate than what they probably would likely have to pay if they waited to start converting or taking annual distributions from this account when their RMDs start. They would want to make sure that they decrease their capital gains realized by an offsetting amount. So just for an example, if they were to fill up the 10% bracket, they can convert an additional $23,850 this year. They would want to reduce their capital gains by that amount as well, or have the realization of capital gains be $72,850. That way they don't incur capital gains taxes on top of this distribution. In this scenario, the taxes paid would be $2,385 on $96,700 worth of taxable income, which boils down to about a 2.5% to 3% tax rate for the year, which is really, really hard to beat. And this likely isn't even the optimal solution for them. Given the balance that they have in their traditional IRA, they would probably want to dip into the 12% bracket as well. And you can do the math with the tax brackets and the offsetting of the capital gains just the same as I did. This is just to illustrate the point. But for Mark and Linda, we'd probably want to start dipping into that 12% bracket as well. The taxless retirement blueprint isn't about being cheap or clever. It's about being strategic. If you understand how the tax system works and sequence your withdrawals intentionally, you can maximize your lifestyle and minimize Uncle Sam. But this strategy does take prudent planning. The wrong move at the wrong time, like claiming Social Security too early or waiting too long on Roth conversions, can throw off the whole plan. That's why working with a planner who understands tax-aware retirement income is so important. At Nav Wealth Partners, we help clients navigate these decisions every single day so they can retire with confidence, clarity, and yes, in some cases, a $0 tax bill. Thank you so much for watching, and as always, make smart money decisions.